What role did bonds play in railway and canal funding? Imagine a time when the world was transforming with new transportation methods. Railways and canals were the lifelines of commerce and communication in the 19th century. But how did these massive projects get funded? The answer lies in bonds, which played a vital role in financing these ambitious infrastructure developments. Bonds were essential financial tools that allowed companies to raise the significant capital needed for construction and expansion. Traditional banking systems and immediate tax revenues could not cover the immense costs involved. So, states and canal companies turned to bonds to secure long-term funding. Take the Chesapeake and Ohio Canal Company, for example. In the year 1878, they issued bonds to raise $5 million for repairs after flood damage. The canal's real property served as collateral, ensuring bondholders would receive revenues until their debts were paid off. This arrangement connected investors directly to the financial performance of the canal. However, risks were present, as some states and companies defaulted on payments during tough economic times or when canals lost their competitive edge to railroads. Railroads also relied heavily on bonds for their rapid expansion, especially after the Civil War. Thousands of miles of track were laid, and the capital needed exceeded what banks could provide. Railroads issued various types of bonds to attract investors. These included mortgage bonds secured by railroad assets and land income bonds backed by revenue from land sales along the rail lines. Some bonds even offered unique features, allowing holders to benefit from capital appreciation beyond fixed interest payments. States and municipalities joined in by issuing bonds, often with guarantees, to support railroads that connected regions and spurred economic growth. The development of the bond market was crucial for these transportation projects. It allowed risks to be shared among many investors and provided a steady flow of funds over time. Bonds transformed how public infrastructure was financed, moving away from immediate tax revenues to a system of deferred payments backed by future income streams. This shift enabled canal and railroad companies to undertake massive construction programs that reshaped the economy and facilitated commerce and settlement. However, this reliance on bonds also exposed investors and governments to financial risks. Defaults and bankruptcies could occur when projects failed to generate expected revenues or when competition, like the rise of railroads over canals, changed profitability. In essence, bonds were central to the financial history of railways and canals. They enabled large-scale capital mobilization, spread investment risk, and linked infrastructure development to emerging financial markets. This relationship illustrates how financial innovation supported economic expansion during the 19th century.